Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we can discuss commodity trading strategies. Why commodities? We are at the beginning of the May. The situation around Iran and the war between the Israel, US and Iran is not fully fixed. So there are still some movements in commodity prices, whether it's oil or other commodities. So we should discuss how we can profit out of these movements. There are approximately 170 strategies related to commodities in our database, but I will today discuss a little different approach and just using the academic research to guide us to find new trading strategies, and it's how we can use the Quantpedia Pro. So we have two articles on our blog which are free to read. So the first one is how to analyze individual equity curves, and second one is the commodity portfolio strategy for potential 2026 inflationary and supply shock regime, and they deal with the different ways how we can build a trading strategy using Quantpedia Pro.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
Let's firstly discuss how to analyze individual equity curves. So let's say that I would like to focus on the US oil. We can use the prices which are in Quantpedia Pro, and there are ETF prices, and we have the ETF United States Oil Fund, which is the biggest and most liquid ETF for crude oil. And further, the thing that we can do is we can run automated seasonality analysis using the seasonality report. So how does it look like? So firstly, we can analyze the seasonality over the months, how the crude oil behaves month after month. This is usually done on the equity. There is well-known sell in May, go away effect, etc. But those strategies are longer term. What I would like to focus is how to test other effects. In the seasonality report, there are prepared events around which you can test the movements of the underlying asset. Those events are turn of the month, turn of the quarter, the Fed, inflation announcement, etc. And one of the interesting events are turn of the month, turn of the quarters, and especially holidays. So what does it happen over the holiday? We have an article about that. It's called pre-holiday effect in the commodities. It's also the strategy in our database. So what does it happen? In the US, there are 8 public holidays, and during those 8 public holidays, people tend to travel. And when they like to travel, they usually travel by car or by plane, and they use the gasoline or they use crude oil, which is used to drive those engines. The price of crude oil and gasoline should go up before the market holidays because there's higher demand. And this is what we can see if we take the seasonality report and we run automated analysis on the crude oil. We can see that few days before the holiday, especially at D-2 and D-1, there is higher performance in the crude oil, and we can do a day's analysis in automated fashion. Here is like trading strategy described, and we can have interesting trading strategy, a very simple one, which we can analyze using the Quantpedia Pro. The second report we can use is the technical analysis report. So for the technical analysis, we have a complete methodology how we calculate double bottoms, double tops, trend lines, etc. Once again in individual article. How does it work like? Once again, you can take any underlying curve, you can run the analysis, and it will show you what are the double bottoms, what are the trend lines, and you can build your trading strategy in automated fashion. Test the trading strategy in the automated fashion using the technical analysis. And the last one is the trading edge analysis. So what you can do in the trading edge analysis in Quantpedia Pro. So there are over 40 different short-term, long-term patterns that you can automatically test. Once again, the complete methodology is here, but we updated this methodology with other underlying testing edges. You select the individual equity curve you like to test. In this case, it's crude oil, and we can run the automated test and find out which strategies work on the underlying asset. And here we have the volatility chart. Here we have a volatility trading strategy. So we can see that there is significantly higher performance in the crude oil if we buy after the highest 25-day volatility, which makes sense. Once there is a high volatility event in the crude oil and the market starts moving in one direction, this is like the trigger you can use to buy the oil, and the oil usually continues to go in the direction of the movement. So you can easily buy after the 25 or 20 or 21-day volatility. If you are in the 10th percentile or 20th percentile of the historical volatility, you can easily buy, and the price of the oil goes in that direction. So these are usually the short-term edges, and we have one more report, trend and reversal analysis, and in this we focus mostly on medium-term tendencies. So in this report, it automatically tests underlying equity curves, whether there are trends between 3-month to 12-month region. So what does it mean? It will automatically test what will happen if you buy underlying asset when it's over its 3-month moving average, or there is a positive momentum, 3, 6, 12 months, etc., etc., and it will automatically test all the trading strategies, show you the best performance look-back period. And in the case of the oil, it's the best look-back period is between 2 and 6 months. So I mean, these are the periods which you can use to build a trading strategy with a trend following focus. So this is how you can build individual trading strategy using Quantpedia Pro. And that is not the only way. So I mean, you don't need to use just one commodity. And this second article is about how to use multiple commodities, how we did it. So firstly, we constructed a diversified basket of 10 commodity ETFs, once again from Quantpedia data. So we use the sugar, copper, corn, gold, palladium, platinum, silver, soybean, crude oil, and wheat. So instead of just using one commodity, we selected the basket that contains 10 commodities. And once we have those 10 commodities, what we can do with that? So firstly, we have a benchmark. So I mean, the benchmark is like equally weighted portfolio of those 10 commodities. We can see that it has a reasonable performance over the last 10 years, but there are some drawdowns and they are not small. And the portfolio of those 10 commodities would realize a drawdown of nearly 40%. So I mean, it's quite risky. We can try to improve this performance. So the performance of that portfolio of the commodities is 7.6% from the inception, and the drawdown is nearly 40%. So it's risky to just hold the individual commodities passively. So what we can do, we can apply cross-sectional momentum. Once again, the complete methodology is in independent article. What is the cross-sectional momentum? But simply say, I mean, the cross-sectional momentum works that you have a basket of the assets, and then you are selecting those that are performing the best out of that, and you are rebalancing on the regular basis. So this is how does it work. And we have a report test automatically, I mean, the individual lengths of the cross-sectional momentum and how many assets do you pick. In this case, here is the example of a 12-month period and how it will look like if we select the best performing 1, 2, 3, 4, 5 ETFs out of the initial portfolio. So we can compare the performances. What we can see is that using the momentum is significantly better than just using the underlying basket itself, I mean buying and holding. So we have a higher performance, better Sharpe ratio, better risk to return ratios, and in a lot of the cases lower drawdowns. Using the momentum improves all of the risk to return ratios and all of the ratios. The cross-sectional momentum is not the only way how we can manage multi-asset portfolios. We can use also time series moving average management. So how does it work like? Once you have, I mean, pool of the assets, you are buying only those that are over the moving average. You can do it in the long short fashion or long only fashion. So once again, there are a lot of the variations how to do that. Once again, we are automatically testing all of them. You can see the results in the table. And the last one is cross asset volatility targeting management. And how does it look like? So what is the problem with the commodities is that they are not equally volatile. So you can have natural gas, which is, I mean, really volatile asset class, and you can have a corn, which is, I mean, significantly less volatile. And when you mix them together and you apply just momentum, and sometimes just due to volatility, there are certain commodities that are picked more often. It doesn't mean that they have stronger momentum. It can just mean that they are more volatile. What does the cross asset volatility targeting management do? Instead of picking it just easily, I mean, each ETF is scaled to 10% volatility target before ranking, and then you do the portfolio construction ranking. And usually cross asset volatility targeting management helps you to pick your winners better, and you have more stable portfolio. And once again, I can run these automatically through the portfolio analysis, through the Quantpedia Pro, through our report. The Quantpedia is not just about the screener. Here we have a portfolio analysis, and in the portfolio analysis, there are like 40 reports that you can run on any portfolio that you built. I mean, here is the example of the portfolio that we selected with the 10 ETFs that I mentioned before. Here are the reports, I mean, at the end. So in the portfolio construction, you can test the technical analysis, you can test cross asset volatility targeting, you can test time series moving average, you can test cross sectional momentum management, and you can test trading edge analysis. Plus, you can test the seasonality analysis that I mentioned before. So I hope that you liked the video. If you like to speed up the process of building your quant trading strategies, feel free to try out the Quantpedia Pro. So not just the Quantpedia Prime Premium, but Quantpedia Pro. It will unlock you all of the features, all of the automatic backtesting tools, and you can build your trading strategies faster. You cannot just use the Quantpedia's database of ideas, but you can test your own ideas in automatic fashion. Thank you very much. Join me in the next video. Subscribe to our channels, follow us on our social media channels, follow our blog, and have a nice day.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.